apologizing ahead of time for all my questions in this chapter. I'm awake now.
I'm awake now, she says. Wow. It's gonna be interesting. Huh? She had coffee. I didn't have coffee.
It's just my favorite topic.
All right. You guys ready?
Yes, yes.
So, if I was bothering you before about the cell phone usage, I'm going to bother you now because this chapter is very, very important. Not only, all of them are important, obviously, but once we get to the tax section of this, it becomes very confusing. And if you're not paying attention, it'll be just like the end of chapter 16. Everybody gets lost. All right? So, plus you don't want your neighbor to be looking at your phone, do you? You want them to pay attention to the material, not to whatever you're texting. If it's an emergency, I will request, as I said before, if it's an emergency, I'll request that you always sit in the back so you can exit. If it's not an emergency, focus. Investment and business brokerage. So before we move forward with this chapter, my question is, what is an investment?
Anything you put money in that brings you money back.
You put money in that brings you money back. Okay. What else? Hopefully, the money that goes does come back, right?
Correct.
All right, what else? What else could be an investment?
Education.
I'm sorry?
Education.
Education is an investment. What else?
Properties. First home.
What else?
Potential return.
Investment is technically a potential return. It's not what you put in, because what you put in could be time, it could be money, it could be effort, right? So technically an investment is some type of return. Now, do you always get a return?
No.
No. So there's different types of investments, and they're classified by low risk, medium risk, and high risk investments. So technically, because I said low, medium, and high risk, technically an investment equals risk. That's what I want you guys to write. Investment equals risk. And once you understand that investment equals risk, you'll understand how to assess investments from here on. Just that word alone says that you should carefully analyze what type of investments you make. Now, low risk investments, let's start with that. Low risk investments. Anybody has a job? Okay. If you have a job, that's an investment. You're investing your time in exchange for a return, and that return is money, right? And some type of security. Yes? Some of us are independent, and all of you, or most of you, will be independent as soon as you get your license. But there's no security, right? Did I say in the beginning of the class that there's no refunds? All right, great. So this business is a high-risk business to begin with, because there's no guarantee whatsoever. It's high risk going in, but then it's very rewarding, so it becomes low risk over time. You guys got it? So if you have a job, low risk, because there's some type of security. You know, if you work now, by Friday or the following Friday you get paid, right? But there is still some risk. There's a risk of you going to work today and they say, you can go back home. So there's a risk of you losing your job. There's a risk of the company going bankrupt, closing down the doors. Does that make sense? Mm-hmm. But it's low risk. Now, medium risk. Can anybody give me an example of medium risk? All right.
Not too high, not too low.
Not too high, not too low, right? It's the one in between.
Yep.
So very easy. Who's in a relationship? Great. So if you're in a relationship, that's a medium risk. You know why I say it's a medium risk?
That's high risk. I'm sorry.
What's right?
That's high risk.
No, I'm going to show you high risk in a second. It's medium risk. Why? Because it involves people. See, a job is a job. You go to work, you do your own, and that's it. You get paid. It's understood that way. People is the biggest variable in any type of investment. Going to work, you are the main risk, whether you're going to go or not, right? It might happen that the company falls down, right? But tradition, that's what it is. But between people, all it takes is one word, and this relationship is over.
That's right.
Because then you start picking at each other, right? It's volatile. People are volatile. So you could last 2 days, you could last 2 years, you could last 20 years, right? You could last forever until one of us, dies. Tradition of the man. But is what it is. Lord, give me a break. That's boom. It's a joke. It's a joke. But it's a medium risk. Now, what about high risk? Let me ask you this. So, forget high risk for a second. We're going to go, today is Wednesday, so it's the Powerball, I believe, right? We're going to go play the Powerball lottery. And you're going to put $2 into that investment, right? $2. Is this low risk, medium risk, or high risk investment?
Low. High risk.
It's a high risk investment with a low cost of entry. High risk investment. Why? Because the rate of return, or the odds of you getting those $2 back, are slim to none. It's low cost of entry. Just like getting into real estate is a low cost of entry. $1,000, which is more or less what you're going to spend between where we are now and where you're going to be once you're fully activated, right? Like $1,000. It's a great way to start a business, and you have no overhead. You see what I'm saying? So that's a low cost of entry. But like I said, real estate is high risk in the beginning. There's no guarantees. The guarantee of you making money in your first year is very little. The guarantee of you making money in your second year is very little. The guarantee that you'll ever make money is very little, because it depends on you. And what did I say that the biggest variable was in any type of investment? People. So you are the biggest variable in your business. It's a low cost of entry, but you're the biggest variable. So gambling, when you go to Atlantic City, or if you gamble with the lottery and just put $2 or $1, it used to be $1 in the dream. Now inflation is $2 and the same dream, right? But the inflation went up, but it's still a high risk. The other day I won $16, but you know how much money I put in?
20.
Like, I was all excited. Sorry. 20. No. For that one I put $2, but
Over
yeah.
10. Charles.
Sorry, just give me one quick second.
You should check yourself out.
All right. Sorry about that. I just have to open the door there. All right, cool. So that is it. We're still in the beginning of this chapter, right? But risk. Very important you guys understand risk. So with that being said, we're going to go to advantages of real estate investment, which is why you're here, right? You want to know about real estate and how to help your clients, not yourselves, just your clients, right? So you're going to look at where it says traditional real estate investments have shown an overall rate of return generally higher than the prevailing interest rates charged by mortgage lenders. So that means what? It means that what you put in generally gives you more than what you have to pay out, right? Now, return includes total income, both direct cash flow, indirect benefits such as depreciation and appreciation. And often investors borrow money to finance the purchase with the expectation that if held long enough, the asset will yield a greater return than that expected. I'm sorry, where are we? Then it costs to finance the purchase. There you go. Just so you guys know, supposedly tomorrow we have an elevator.
Elevator?
Yeah.
Oh,
Still come up and down the stairs, but supposedly tomorrow we have
No
it.
excuse to be late anymore. I'm gonna get stuck.
I just said I'll be on time.
We'll be on time because of the elevator. She meditates for half an hour downstairs before she comes up the stairs. I can do this, I can do this, I can do this. All right. So let me ask you something. It says here, using borrowed money this way is called leverage. If I have $100,000, and this is the same example I make in every single class. I have $100,000 cash available right now, and I see a house that it's $100,000. What would you do?
The 20,000 and finance the rest.
Why 20,000? Why not less?
Well, it depends on what kind of loan you get.
It depends on what kind of, yes. So, but put 20,000, finance the rest. Why wouldn't you buy cash? You got the cash.
So you need
Why
the
have a
money
mortgage?
to fix it up, maybe improve it, so it'll be worth a lot more money.
Could be.
That's coming with the loan.
It could be, but it could become with a loan as well, but it might not. Sometimes you don't know. But think about it this way. If the average property in the area is $100,000, right, and you have 100,000, we know that traditional loans, conventional loans, are 20% down. So with the same 100,000, how many houses can I buy? 5. That's called leveraging. So why would you stick all your money into one property? And I'll tell you this because of the disadvantages of buying real estate. It's not all pretty. There are disadvantages. Okay? So, unlike stocks and bonds, real estate is not highly liquid over a short period of time. So if you put all your money there, here's what happens. An investor cannot usually sell real estate quickly without taking some sort of loss. You put all your money there, but now you need the money. There's an emergency. You need your money. If you go to the bank, you can cash out. Right? Yes? If you have stocks and bonds, you can just sell them. And sometimes the same day, or most of the times the next day, but sometimes the same day, you get your money in your bank account. Correct? Real estate, can you get your money the next day?
No. No.
Yes, you can. For a huge loss. You guys got it? So why would you put all your money into that one property? Right? We have a contract right now going on. The guy only needs to put $30,000 as a down payment. He wants to put $150,000. I'm like, sure. I mean, it's your money. And this is a single family. Like, it's your money, but why don't you put, just my suggestion, my opinion, why don't you put the $30,000 and use the remainder of the money to invest into a multifamily?
I don't want to be a lender.
Don't want it. Don't want to be a lender. It happens.
They don't listen. They don't listen.
No, listen, it happens. But this way, you guys need to understand what a deposit is, what a down payment is. You're purchasing immediate equity. That's what it is. So in the event of default, in the event of the market going down, what you might lose is what you put in, like those $30,000. You can quickly sell the property at the current market value. But what if the market crashes and you have no equity? Then you're definitely not getting anything back, and you still have the obligation because you're upside down. Right? We talked about being underwater, the short sales, the deficiency judgments, right? So that's why you put the down payment. Just make sure you leverage. Also, it is difficult to invest in real estate without some degree of expert advice. Investment decisions must be made based on a careful study of all the facts in a given situation, reinforced by a broad and thorough knowledge of real estate and the manner in which it affects and is affected by the marketplace. What does it say right after? Volatile risk. That's what it says. Human elements. Market changes because people want to pay more or pay less for certain things. In this case, the market was driven up, right? So humans said, right, because no dog says, I'm going to put 500,000 on this house. So humans said, I'll pay 500. It's worth 500. And here comes a rundown house is now worth 400, just because of that, right? And people are willing to pay 400 for that rundown house. That means that the brand new house is now 700 in an area where not too long ago was worth 400. You see what I'm trying to say? So human element, we're the ones that change the values. Now, all investors should seek legal and tax counsel before making any real estate investments. The legal counseling, for me, is not the biggest concern. Because legal, I don't know. If I get sued, I got 6 years to figure it out. Taxes, every year they're going to knock on my door and say, well, not literally on my door, but every year you have to report the money you make or the losses. Does that make sense? So my biggest advice to you is, when it comes to investments, and as realtors, you are independent, so that's your first investment. My biggest concern is to get a CPA first, before you do anything else. Because IRS does not forgive, right? They might forget for a while, and then you get a call from India saying, go to the next CVS and buy a green dot. That's a scam, it's a different one, but they send you something, right? So get a CPA. If you don't have a CPA, I have a few that I can recommend, and they're very, very helpful for investors and realtors, okay? Next. Rarely can a real estate investor sit idly by and watch his or her money grow. Management decisions must be made. For example, can the investor effectively manage the property personally, or would it be better to hire a professional property manager? How much rent should be charged? How should repairs and tenants' grievances be handled? See, these are all questions for somebody getting into a property. The person that I told you that has $150,000 as a down payment towards a property, they don't want to handle any of this stuff. These were the questions in their mind. Tenants? No, I don't want a 2 o'clock in the morning call about a toilet that's not working, right? It's not the call you want. But here's the thing. Sometimes when we buy properties, they're not as profitable as we expected. So sometimes it has to be us at 2 o'clock in the morning to go there. And that is called sweat equity. It's us putting in the work instead of contracting for services. Again, why do we have to do this? Because if you want to make the assets profitable, you're not just paying out money, you're putting some work yourself, right? Otherwise, it's a loss. Any questions? Yes, no, maybe? Great. Finally, a high degree of risk is often involved in real estate investments. There's always the possibility that if held, there's always a possibility that if the investor's property will decrease in value during the period of time that it's held, or that it will not generate income sufficient to make it profitable. We cover this. Now, this one's one to think about. Investment. The property held for appreciation is generally expected to increase in value and to show profit when sold at some future date. Okay, appreciation. Income property is property held for producing income as well as profit on its sale. So my question to you guys is, which one would you prefer?
Income property.
Why?
Because in my case, I would be looking at more of an income right now versus a later date.
Okay, great. So with that being said, who has, raising your hand, I didn't ask the question.
No, I was going to say my answer for the other topic. I think that it depends on which property you're looking at and what your intent for the property.
Yeah, of course. Everything is based on your intentions. And that's why I was going to ask, there's a few homeowners here. Who made their first purchase a single family? All right. Do you feel that was a mistake? No?
No,
No?
maybe,
Maybe. Okay.
would it be better?
Somebody's wise. All right, so a single home. A single home is an appreciation property. It doesn't generate income. You expect to have a future value, right, higher value than what you paid for, but doesn't generate income. My advice to you, and apparently the book has the same idea, my advice to you is that the initial investment in real estate to be a rental income property. Why? Because if you lose your job, and this, when somebody comes to me and says, Bruno, I want to buy a house. Okay, great. What are you looking for? Single family. My question is why? Right? Off the bat, I just want to know, why would you like a single family to be your first purchase? Why? Because we have different programs. Right? FHA allows you to buy, as a first-time home buyer, allows you to buy a 1 to 4 family with 3.5% down payment. So why would you waste your 3.5% down payment option on a single family? Does that make sense? Or the veterans, same thing. You can buy up to a 4 family with no down payment. Why would you waste that opportunity on a single family? All right, everybody has their reasons, but let me explain mine. Mr. or Mrs. Potential Buyer, if one of you loses your job, can you afford the mortgage? If the answer is yes, I will not fight with you anymore. This is it. You already understood my question. I don't have to go any further. If the answer is, oh, yeah, well, probably not. Great. So this is what I would advise. With the same 3.5% down payment, you're able to buy up to a 4 family where the rental income is there, and it will help you at a future date, so in a year or 2 years from now, will help you buy that single family you want. Now, I'm doing 2 things here. 1, helping them buy multifamily that will generate income. And 2, I'm preparing the grounds for them to feel how good it is to have a rental property. And a year from now, instead of buying a single, they're buying a 3 family now. And then a 2 family. And then eventually they'll go for the single family.
And he's securing his commission for later future dates.
Exactly. But the idea was to help my clients first. Because if I don't help my clients, right, they will lose their property. What do you think happened with most of these purchases in 2000 up to 2008? Granted, a lot of them were multifamilies and very high priced, but people lost their jobs. They were okay with everything, but as soon as they lost their jobs, they couldn't afford it. You're supposed to have 6 months to a year's reserve, right? 6 months to 1 year's reserve of all your expenses. That means that whatever money comes in for that month should pay your month, right? You should have 6 to a year of that set aside in case something happens. But no, we don't. We're in the United States. Everything is easy to buy. So you know what? I get paid in 2 weeks anyway, so let's do this. I got the smile. You know what I'm talking about, right? So I'll save later. Right now I need this. All right, so my point is preparing yourselves for the future. And that's how I talk to my clients. Right?
Clients don't have the mentality to be a landlord. They'll tell you they don't want to have the
Mm-hmm. That is fine. But if you allow your clients to go for a single family right away without explaining options, then what kind of service did you provide? Listen, 9 out of 10 people that come to me or to our agents, they will be converted to multifamily. A lot of them don't go for more than 2 families, right? But there's a few that go to 3 and 4. It just secures your future. And I understand, oh, I don't want to deal with tenants, and then I have to evict them, and then I have to this, and then I have to that. We can talk about that later. There's other ways to secure your tenants and not lose them at all. There's different programs. Right now, you even have Airbnb if you want to. Right? Airbnb will even pay you more, most of the times pay you more than what you would get in rentals, without having to deal with evictions and insured by them. Right? This is just an idea. We can do so many things once you have that property. But at least your income is protected. If you lose your job, that's what you get. Right? Victor, you were going to say something about that? I thought you were. All right, why did you choose a single family? Because you said, no, I did a good investment with a single family.
Oh, I don't know. Like, honestly, I didn't know back in the day. To me, it worked out pretty fine because I paid only like $180 for my house.
Okay.
And I was worth like, nearly 400K, so.
Yeah, so that was the appreciation.
Yeah.
But what if you had lost your job? Could you afford it? Those are always the questions to have in mind. Because a single family is just expense. That's what I'm talking about. There's no immediate return. There's a future return if you have to sell, right? But there's no immediate return or security. And is your job secure? No. I'm sorry?
Nothing is
Yeah, well, we'll talk about that another time. You guys understood this?
Yeah.
Great. It's great to have a single family, obviously. If anything happens, you lose that, you go back to renting, and it's very hard to get back on the horse. That's what it is. If you go through foreclosure, I told you guys 7 to 10 years without being able to buy something else, right? All right, before you guys highlight, everybody goes highlight happy. Right above cash flow, and before I address this, but right above cash flow, I want you to write two things. One is going to be Rich Dad, Poor Dad. Rich Dad, Poor Dad by Robert Kiyosaki. Sorry?
You gonna bring Robert again?
Hey, listen, Robert Kiyosaki is awesome. The other one is going to be Cash Flow Game, also by Robert Kiyosaki. You guys want to understand how to become investors or how to help your clients? What do? Read books, educate yourself. Rich Dad, Poor Dad is great to explain to you that you could be an employee, you can be a business owner, which is pretty much being a slave, right? You could be an entrepreneur or investor. Very important to know the difference between these, right? And I'm not going to go in detail right now. If you don't like to read, and I don't like to read, right? That's why I give the audio to you guys. If you don't like to read, and I just like I don't like to read, get Audible. Audible.com. It's an app, and you get to listen to the books. All right. It's only like $10 a month, and you have like 2 books every month through 2 audiobooks. Yes.
My ex-husband read this book, and he didn't want his house anymore. Yes,
After you read the book, you
because they say you have to invest in money.
So you got rid of the wife, got rid of the house, got rid of.
Was he in a single family?
Is it single family?
That's why we had single family.
Oh, okay. Now I got it. I'm sorry, listen. Just you said my ex-husband. He read this book, got rid of the house. So the house, the wife, everything.
The dog, you can have it all.
No.
No, you got rid of him. That's it.
He stopped to pay because he said it's not dressing. I have the house.
Oh, I got you.
I told you, and 2 weeks ago he lost the house because he
Shame.
said it's crazy. After this book.
Listen, sometimes it's the best thing. Let go. I used to help people not lose their homes, and I told them sometimes the best thing is to let go. It's just not worth it.
Well, a real estate agent to help you.
Oh yeah, to let go, to help you let go, right? Of the property. So, yes.
We are counseling in many ways.
Yeah, you mentioned Audible, Scribd, SCRIBD.
Yeah, Script. They have it as well.
Unlimited books for a monthly fee.
They have audiobooks as well.
Yeah.
Oh, great. That I did not know. Thank you. Appreciate it. There you go.
How's it going?
So scratch Audible. We're gonna go for Script. SCRI. I use it. You know what I use it for? For PowerPoint
PDFs.
presentations, PDFs.
Yeah.
They have a lot of stuff there.
Uh-huh.
I have the subscription, but I didn't know about audio.
Yeah.
Script. SCRIBD. But definitely search for Rich Dad Poor Dad. Start with that one. This is one of the first books you should read. And I can recommend a bunch of books to start your business. One of them is Start with Why. Because if you don't know why you're doing this, you're just wasting your time.
What is it called again?
Start with why.
Start with Why by Simon Sinek.
I said, I believe I have the ebook for the Rich Dad Poor Dad.
You do?
I could check it. If I have it, I can send it.
So you want to send to everybody and breach copyrights and all that stuff? And you're saying this live, Claudia.
I did purchase the book. I want to share.
Want to share?
Yeah.
She wants to let everybody borrow.
I'm sharing.
But yeah, you guys can Google. There's a lot of obviously you're breaking a bunch of laws, but you go to Google and you say Rich Dad Poor Dad PDF, and you can download it, or you can go to Claudia Crespo, right? And she will provide it to you.
Her full name alive?
I did not.
That was horrible.
That was horrible.
That is not my real name, by the way.
Ooh.
I don't know.
What, you mentioned start with Y, what's Simon's last name?
Start with Y. It's Simon Sinek. S-I-N-E-K.
No.
S-I-N-E-K. And that's one of my favorite books, by the way. Start with Y.
Okay. S-E-R. Sorry.
I-B-D.
He isn't there.
Too much info.
SCR. We got SCR. Yeah, you got it.
Just saying my favorite.
You got it?
What do you think about Napoleon Hill?
Script. What do I think about Napoleon Hill? For a starter book, no. That's the one. Script. Go with Dale Carnegie. For starter books, Dale Carnegie is great. Anyway, I can give you a bunch of references, a bunch of books, but go here and look for Rich Dad Poor Dad. That's what it is. Start with Why is definitely amazing. There's just too many to even mention.
I have a recommendation. You should have Google's recommendation list, put it on the Facebook group, now no problems.
I do, it's just not on the Facebook group. It's on a different page. I will eventually put it there. But I do have already recommendation with my affiliate link to Amazon in case you guys want to purchase. And I get paid for every book you guys purchase, just saying.
Yeah.
You know.
No
All right.
extra charge.
Passive income.
What it is.
You wanna write your own link
She's checking out your Amazon link so that she can make you money.
down? Or if
Alright.
anybody else wants to, you know.
No, I know what you're saying. All right, so go back to this real quick. The other one was cash flow game, and this is like Monopoly on steroids. Okay. Cash flow game. If you guys don't know what Monopoly is, again, this is also by Rich Dad. It's a board game. All right. I know we're probably all adults and we're like, board games. I don't play that thing anymore. This is a real life application. It's very detailed. Forget how fast you can become a millionaire. The idea behind this is what the book preaches, which is getting out of the rat race. What is the rat race? Always chasing money to pay your bills. So forget the millionaire, because that's one of the things that I hate about all these advertisements. They're clickbait.
Yeah.
Become a millionaire quick. No, forget that. Get out of the rat race, play this game, find a group of people, and play Monopoly. Just have fun with it.
Play
It
with your
is-
kids.
Play with your kids. My son, I bought him the cash flow for kids. He loves that book. He read it already like 3 times. I have this game on my phone. Every time he's with me, guess what he asks for? Can I have your phone? I want to play it. Yeah, absolutely. Well, anything games he wants to play, but one of these is something that I would not expect him to want. He wants it. All right, so go through it. It's a very interesting game. All right, back to the book, cash flow. So why cash flow game? Why cash flow? What is this about? The object of income property, meaning the goal of having income property, is to generate spendable income, usually called cash flow. Now, the cash flow is the total amount of money remaining after all expenditures have been paid. That means you paid every expense with the house, and hopefully there's some pocket money left over, right? So if your expenses with the house are roughly $2,000 a month, but he brings $2,500, how much cash flow do you have? You have a $500 positive cash flow, okay? Generally, the amount of rent or income that a property commands depends on a number of factors, including location, physical appearance, and amenities. Now look what I have in green. If the cash flow from rents is not enough to cover all the expenses, then we have a negative cash flow. So if all the expenses are $2,500, but the property only brings $2,000, now we have a $500 negative cash flow. That means you're paying for that property. That's not the objective or the goal of having income property. It's not for you to pay for it. It is for it to pay itself and give you a return. Does that make sense? Good. So the numbers should be simple. I see a lot of people buying houses, $600,000, $700,000, $800,000 here in the Ironbound section. The rentals will not cover it. So even though the prices are going up, make sure you guys don't buy it, because it doesn't make sense. Rentals do not cover it.
A lot of people just buy for status. I bought a $600,000 house.
That's why people live in New York. Status. Anyway. All right, pyramiding through refinancing. Pyramiding through refinancing. By holding and refinancing using equity and appreciation buildup, rather than selling or exchanging already owned properties, an investor's holdings can be increased without investment of any additional capital. This practice is known as pyramiding. So by reinvesting and doubling his or her holdings periodically, it is conceivable that an investor who started out with a small initial cash down payment could own heavily mortgaged properties worth hundreds of thousands or millions of dollars. With sufficient cash flow, right, return, to cover all the costs, if market value holds steady or increase, the income derived from such assets could pay off the various mortgage debts and show a handsome profit. All right, what am I saying here? Does anybody remember HELOCs?
Yes.
Home equity line of credit, right? Now let's go back to what I was telling you about buying a property and putting a small down payment versus a bunch of money. If you're in an increasing market, so let's talk about Victor's property. You said you bought it for 180 and now it's worth how much?
Nearly 400.
Nearly 400. There's a lot of equity there. How much down payment did you put on that property?
It was a VA loan.
I'm sorry?
It was a VA loan.
It was a VA loan, so nothing. Great. You took advantage of that towards a single family. It happens. Right? Not everybody's perfect. It just happens. But it was a great deal because you have the appreciation. What can you do now? Get a HELOC. See, whether it's a single family or multifamily, it doesn't matter. It's preferable to be a multifamily so it pays itself off, because now when you take that HELOC, the rentals would still pay for the extra amount of money. And you could use that money to do what? Invest in another property. And if the numbers are right in the increasing market like we've been, right, it will still pay itself off. It will accrue the appreciation of the value of the property, right? So build equity. And now you have another property that you can squeeze out equity and buy another one and another one. So pretty much from one single investment, what can you do? Piggyback and buy 1, 2, 3, 4, as many properties as you want. Just numbers, the numbers have to be right. That's the only thing. That's what we're saying here. Okay? So you could start with one, build a bunch. The problem is, in a steadily declining market, however, investors could find that properties are worth less than what they paid for them and have to dip into their reserves to make up for the negative cash flow. Right? And that's what happens with the market crash. When people are trying to sell, oh, the market's crashing. Sell now, at least recover something. A lot of them were too late. They became underwater. Right? Underwater meaning they owed more than what the property was worth. Now let me ask you something. If these were all income properties versus appreciation properties, right? These were all income properties and the market crashed. Would it bother you? Would it bother you that much?
Not if your numbers was right.
If your numbers were right, it was still getting paid. And like I told you yesterday, this is cyclical, right? It goes down, comes back up. It goes down, comes back up. So a lot of people now, right, we talked about this in chapter 13 as well, when we talk about foreclosures. A lot of people now could actually sell their properties without going through foreclosure because there is equity or they're right there. Does that make sense? So they were once underwater, now they're above water. So somebody that has the cash flow is not as bothered as somebody that doesn't. Because market goes up or goes down, hey, I still have my money coming in. Simple as that. I'm secure. I'm sorry.
Yeah, rent goes up every year.
And rent goes up. Especially now. Like here it doubled almost. Crazy. All right, now we're getting to the rough side of this. It was easy until now. It was fun, making money, right? Taxes. Now, one of the main reasons real estate investments were popular and profitable in the past was that federal law allowed investors to use losses generated by the investments to shelter income from other sources. Meaning, if you lost here, you wouldn't have to pay as much in your salaries, for instance. So you made money, like you're $100,000 or more, so you're a different bracket now. So you pay more in taxes. But because you lost in the real estate, you should be able to shelter and not have to pay as much. Well, all that changes, right? So too much tax shelter can backfire by making the investor subject to AMT, alternative minimum tax. And this is one of the reasons why I tell you guys to have a good CPA. One of the reasons. Because everybody, especially if it's a cash business, right? Do you declare all the cash? That was great. But most people don't. They don't declare all the cash. And I'm not telling you to, and I'm not telling you not to, because that's not my monkey. That's your problem. If you ever get audited, it's definitely your problem, not mine, right? But you should consult with a CPA on what you should do or not do, and how to legally reduce your tax burden. And that's where this comes into play. That's why you need to pay attention, okay? For instance, one of the ways that you can avoid taxes is doing exchanges. Now, this applies only to investment properties. So it says right here, real estate investors can defer taxation of capital gains by a like-kind property exchange. Note that the tax is deferred. Please underline, double underline, triple underline. It's deferred, not eliminated. Okay? Deferred, not eliminated. What does that mean? Deferred means postponed. That means later on, we'll take care of that. You don't have to pay taxes now, but you will pay later, probably. Now, if the investor sells the property, the capital gain is now taxed. So think about it this way. I bought this property, I sold the property, I bought another property with that money. Did I make money?
Yeah.
No, I just rolled over.
Okay.
All right? That's what it is. I rolled over the money. As long as you don't touch the money, and I'm going to go over that in detail, as long as you don't touch the money from that original sale, the gains roll over to the next property. And therefore deferred until you sell the next property. If I sell this property and I roll that money over to another one, do I have to pay taxes? No, because I did not touch the money. It's in another property. Does that make sense? All right, so we're going to go in detail now, but it is something that you're also going to learn in Rich Dad, Poor Dad, and a few other big guys that talk about this, which is defer, 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 and then die. This way, do you have to pay taxes? No. So to qualify as a tax-deferred exchange, the property involved must be of like kind, and that is income or investment property. For example, a landlord moving across the country, so landlord means you have an investment property that you're renting. A landlord moving across the country wants to sell an apartment house and buy another that she can manage in the new location. Now, if she has to pay capital gains tax on the sale of this one here in Jersey, she will not have enough money to buy another one over there. Because capital gains vary, and we're going to go over the percentage in a little bit. But she might not be able to invest in the next property. So what it says here, by using a tax-deferred exchange, she can in effect swap the two properties with no immediate tax consequences. So what she will do is contact somebody, hey, I'm moving to San Francisco, do you have a property to sell that's similar to mine and of similar value? So mine is a 3-family, theirs is a 2-family. It's still investment properties, but in San Francisco, the value is similar to the value here, as an example. So as long as they're the same value or similar value, did I touch the money? No. We swapped. I now live in San Francisco. That person lives here in Jersey. We swapped. There's no touching the money. Okay? So the gain on the first sale is not tax exempt, but tax can be postponed indefinitely, then added to the gain on the second property when it's sold sometime in the future. Good news is that it's hard to find somebody that wants to swap a property with you, right? So the good news is that the Internal Revenue Code has something called Section 1031. And the Section 1031 of the Internal Revenue Code allows you to exchange properties with yourself. Meaning, it allows an investor to sell one and buy the other one outright. So again, did I touch the money? No, I sold property A and I bought property B with the money that came from property A. So money involved is held by a third party until the transaction is completed. And look what it says next. Something that people don't listen. I mean, does anybody ever listen to advice?
No.
So here you go. It says the investor must identify the intended purchase within 45 days of selling the first parcel and complete the purchase within 180 days. What does that mean? I sold property A today. From today, I have 45 days to find property B and say, hey, this is the one I want to buy. The money from the closing stays with the attorney or the title company. So it's held in escrow. You don't touch the money. Okay? So I said, this is the property I want, 45 days. From today, not from the 45 days, from today, I have now a total of 180 days to close on the second property. You guys got it? This is to defer the payment of capital gains. This is only for investment properties, because if this was a primary property, primary residence, do you pay capital gains? It depends. If you're single, you're exempt up to $250,000. If you're joint, married, filing jointly, you're exempt up to $500,000. So I'm just giving you another hint, right? If the 45 days are gone, did you live there for at least 2 out of the previous 5?
Yes.
If the answer is yes, then don't worry about this. You wouldn't have to pay capital gains anyway. As long as you can prove that you lived there 2 out of the previous 5, you're good. You guys remember that from chapter 8?
Yeah.
Great. All right, so these are things to think. Primary residence, you're exempt up to certain limits. If it's investment property, we have to move fast. 45 days to find the property, 180 days to close, and you don't pay capital gains right away. It's postponed. Any questions here before I move forward? No? Now look where it says here. When the property being bought, that means the replacement property. Property being bought costs less than the one being sold. The difference in price is known as boot. So we have $100,000 from the sale of this one, and we're buying one for $50,000. That means that the remaining $50,000 are going to come to our pocket, right? Yes? We rolled over only 50, the other 50 came to our pocket. These 50,000 that came to our pocket are booted out of the exemption. They're kicked out of the exemption. That $50,000 that came to the pocket, that's why I say don't touch the money. The $50,000 that came to our pocket is immediately taxed as part of the investor's capital gain on the first property. So you either roll over the whole money and don't have to pay taxes right away, or any money that you touch, that you take out, goes to your pocket, is immediately taxable that year. Questions?
Can you purchase 2
No.
properties? So you have 1 for 1.
Okay, upgrade. He bought one for 180. It's now worth almost 400. Now he's going to roll into a $400,000 house. If you think about it that way, it's an upgrade.
Correct.
Better rentals, better everything. Right? So you use one investment to get into a better property later on. Yes.
So is he able to buy income property to sell a single family home? To sell a single family home?
Yeah, he can buy whatever he wants.
He can buy
Yeah.
income property.
He can buy whatever he wants. The question is the exemptions. So in this case, if that property, the single family, was an investment property, because single families could be investments. I can buy a single family to be just a rental property, right? If that single family is a rental property, it's an investment, you could use the same practice here. So instead of paying capital gains on $220,000, right, he just rolls over into a better property and gets better returns. That's all it is. You guys got it? Great. Now, what is capital gain? Capital gain is a taxable profit on an investment. In real estate, please highlight, underline, put stars. It's the difference between adjusted basis of the property and its net selling price. So capital gain is what I took home minus what I put into the property. So the purchase, physical improvements and all that. So I took home after paying, we're going to go over this in a second. After paying the realtors, after paying the closing costs, I took home $100,000. Is that my profit? No, because it cost me $50,000 to purchase, and I put another X amount of dollars to fix. So my net, what I have to pay taxes on, is that difference, the smaller difference. Okay? At various times, tax law has excluded a portion of capital gains from income tax, and in order to qualify for favorable long-term capital gain tax treatment, the asset must have been owned for the required length of time, referred to as, please underline, holding period. Holding period. Okay. What is the holding period? It's how long you held the property in your name. In 2017 and still today, the holding period for long-term capital gain treatment was more than 1 year. So as long as you held the property for more than 1 year, the maximum that you would pay in capital gain tax is 15%. So if your profit was $100,000, how much would you have to pay IRS today? $15,000. If it was short term, so less than 1 year, it's treated just like depreciation. It's treated as 25%. Yeah. So my question now is, which one would you rather pay? 15% or 25%?
15%.
Really? Really?
That's only two options you gave us, but I would really say nothing.
Go with the nothing. Tell me, Bruno, no, I know there's another option. It's multiple choice. There's always 4. I just gave you 2. There's 2 more coming. But none. You don't want to pay capital gains, do you?
No.
So what do?
Keep on rolling.
Keep on rolling. Just defer it to the next property. Simple as that.
And there's no limit to that, right?
It's indefinitely. Huh?
Did it?
So just keep on rolling to the next property, defer, die. That's what you need to think. Defer until you die. And you'll never pay taxes on it. And this is legal. It's Internal Revenue Code, Section 1031. And this is true, applies to every investment. There's Section 1032, 33, 34, and 35, which applies to 401ks and IRAs and all that stuff. You can roll into different products without having to pay capital gains on those.
Is there a limit to one property or as many as?
So, get a very good CPA, and the question to the CPA is not going to be, how can I not pay taxes? The question is, how can I legally reduce my tax burden? Simple as that. You got it? Don't ask for tax evasion. Ask for tax reduction. Okay? This is the easy part of taxes so far, by the way. Basis. Where it says basis, I want you guys to write cost. Sorry. Right where it says basis, I want you to write cost. Because the basis, just like any investment, is what it costs to purchase. Okay? So it says right here, the basis of the property is the investor's initial cost of the real estate. The investor adds to the basis the cost of any capital or physical improvements subsequently made to the property, and subtracts from the basis the amount of any depreciation claimed as a tax deduction to derive at the property's adjusted basis. Okay, so how do we get to adjusted basis? It's the cost to purchase plus any improvements. That's the adjusted basis. What is basis? Cost. Got it? Good so far? Yes?
Yes.
Great. When the property is sold by the investor, the amount by which the sales price exceeds the property's adjusted basis is the capital gain taxable as income. And we're going to go over an example right now. You guys ready? And I'm going to teach you guys how to read and break down questions just from this. I always do this here. It says, for example, many years ago, an investor purchased a one-family dwelling for use as a rental property. Let's stop right here. If it says many years ago, was long-term or short-term?
Long-term.
So if the question will be about taxes, you already know that the maximum they have to pay in capital gains is 15%. See? Break it down. Simple. It's used as a rental property, so you know it's investment, so you know 15% capital gain. If it was primary residence, does this even matter? Many years or not? No. As long as they live there, you're good. Now the purchase was $45,000. And the investor is now selling the property for $100,000. What would be the capital gain? Just stopping right here. If there was nothing else said, what would be the capital gain? 55. So many years ago, and 55,000, you know it's 15% of the 55 is what they would have to pay. You guys got it? But this question is a long question. One of those you skip to the end. It says, shortly before the sale, the investor made $3,000 worth of capital improvements to the home. That means that their basis was just altered. The basis was not 45, it was 48. So the adjusted basis is 45 purchase plus $3,000 improvement. And over the years, they claimed $10,000 worth of depreciation. Okay? Try not to fall asleep here. So $10,000 claim as depreciation over the years. I'm going to explain depreciation in a second. The investor is paying the broker a commission of 7%. You guys see it's possible. 7% commissions. And the closing cost of $600. That's impossible in Jersey. Now the investor's capital gain is computed as follows. Let's highlight this. Before I give you the rest, right here, I want you guys to write gross. Gross, gross selling price. Only for you to remember the same thing as your paycheck. There's a gross pay, there's a net pay. The gross selling price is not what you take home because there's deductions. The first deduction is the commission. Nope. Commission. Guys, we're the first ones to get paid in every single real estate transaction. We get paid right off the top.
I thought you were talking checks, the paycheck.
No, right here. We're the first ones to get paid. Our license is so powerful that nobody else gets paid until we get paid. It all happens the same day at the same time, but we get paid right off the top. So minus 7,000. After that is when the closing costs come in. So minus 600. So attorneys, filings, and all that stuff comes right after. So that means what the investor took home was $92,400. That's his net selling price. What they took home. basis, they put $45,000 in. Right before the sale, they put $3,000. So what is the adjusted basis? 48. So it would be 92,400 minus the 48, correct? No, because they claim depreciation. And depreciation over the years is a benefit. Okay? So what does this mean? It means that I put 48,000, but then I had a benefit of 10,000. How much did I really put in? 38. I'm going to address it in a second. Just give me 1 second. So $38,000. So now this is the adjusted basis. The cost, the real cost was $38,000. What I put in minus what I claimed in benefit over the years, $38,000. The total capital gain was now $54,400. How are we being taxed here?
15% of 54.
15% of 44. Because as I said on the left side of this page, depreciation is always taxed at 25%. So here's what just happened. Not only did you get the benefit every year, they made you pay it back in the form of benefit, right? And charge you 25% on top of that. So literally this benefit is costing you 125%. Not bad, right? What was your question? I'm sorry.
How do you establish depreciation?
Very good question. Here's the answer. Depreciation. I knew what it was. I just wanted you to say it again. I've read your mind. So depreciation is an accounting concept that allows an investor to recover the cost of an income-producing property by way of tax deductions over the period of the asset's useful life. Only costs of improvements to land may be recovered. Please underline, double underline, triple underline, not the cost of the land itself. So with that being said, who can describe to me what is or what are improvements to the land? The building? That was your final answer? What else is considered improvement? This is chapter 5. We talked about land and we talked about real estate. The building, what else? We got building already. What else?
Roadways.
All right, so land is defined as raw land. Land is defined as raw land, as nature intended. Real estate is land plus all improvements, including buildings, right? The pipes for the gas, for the water, right? The electric, the paving, the garage, the pool, anything that's man-made, anything that's added to the land is improving the land. Because raw land by itself is not improved. So what we said right here is only cost of the improvement may be recovered, not the cost of the land itself. You guys got it? Yes? No? Maybe? Sometimes? How's this? All right. On residential property, so Victor, on residential property, the cost of the building is divided by 27 and a half years. So that's how we figure out what is the depreciation. So to make the numbers simple, if the cost of the building was $275,000, this math is easy. $275,000 divided by 27 and a half years, that means that every year we can claim $10,000. The 10 was right. I know, it's right before lunch. Right? Your other brain is asking for... So it's $10,000 every year that I can claim. Because it's the cost of the building divided by 27 and a half years. That's how much I can claim every year as depreciation, as a benefit. Now, what does this mean? Assets, useful life. Eventually, don't I need to replace this? Or the floors?
Yeah.
Or the roof?
Yeah.
That's the assets, useful life. It's how we expect think about the milk. We get the milk and it says best by a certain date or used by a certain date, right? That's the asset's useful life. Eventually you need to replace that milk. You got it? When you replace that milk, you can deduct again the cost of that milk. In this case, if you replace the roof, you can deduct over another 27 and a half years the replacement of the roof. That's why when you go to a CPA, they ask you, did you do any improvements to the property? The answer is yes. Great. What was the value? And that all goes into your deductions. Good so far? Now, in the state exam, if there is a question, the question is going to be something like, John held the property for 29 years. It cost $300,000. How much can he deduct? Let me ask this again. John held the property for 29 years. The building cost $300,000. How much can you deduct?
I'm saying investment property.
Just assume for my purposes right now, we're in investments.
27.
But it's an investment property. How much can he deduct? If you guys are using calculators, you're wrong already. He held the property for 29 years. The max that you can deduct is 27 and a half. So the answer is 0. See how easy it is to trick you?
Wait, start over.
No, I'm done.
So because he had it.
You
more
could go
than
for the
27
reruns.
Because he had it more than 27 and a half years, he can no longer do on depreciation?
You can no longer claim depreciation. The max is 27 and a half years. If the question said, like we had in this one, where he made another $3,000 worth of improvements, those $3,000 would be divided over another 27 and a half years.
Okay, I get it. So it doesn't matter how long you kept it, but if the improvement.
The improvement itself is 27 and a half years. You guys got it now? Yes? Great. So the answer in the state exam is?
0, yeah.
Kind of like saying cross the whole thing out. Just 0. All right, and again, as I said, until now, this is the easy part. For the next 10 minutes, I'm going to confuse you even more.
Okay.
All right. Anybody wants coffee? Not you. Anybody wants coffee? Go get it now, because this is going to get complicated. We have 20 minutes left. I want to make sure you're awake. Some of you are already like, please stop. Right, Celine?
Yeah.
Great. No coffee? Great. That's get over. Deductions and federal tax laws. Now, federal tax law limits the deductibility of losses from rental property. I told you there's not much you can deduct. There's limits to everything, right? But you can deduct stuff as long as you're an investor that actively participated in the management of the property. What does it mean, active participation? Right? If we all get together and buy a property, and I'm the general partner, and you guys are limited partners, do you actively participate?
No.
No. As you guys already know from chapter 7, I keep on giving references in case you need to go back. As you guys already know from chapter 7, limited partners are silent partners. What does that mean? They put up the money and they have no say on the management of the business. So if I'm the general partner, I can use the losses to reduce my tax burden. You guys cannot. You can only do it to a certain extent. So think about it this way. Passive losses go after passive income. Active losses go after active income. So if you made, your wages are active income, right? So if I made $100,000, I have to pay $30,000 to the IRS. But I'm the active investor in this deal, and we lost $20,000. How much do I have to pay the IRS?
10,000?
$10,000. Because I'm actively participating, that loss goes against my active income. So it reduces my tax burden. These are not the exact numbers, but just to give you an idea. Active goes against active. Active loss goes against active income. Passive losses. If you guys have, you are the limited investors. If you have the $30,000 loss here, right? Then you can only go and reduce your tax burden on passive investments. So let's say you made $30,000 or have to pay $30,000 from mutual funds. You're not the one investing, somebody else is, right? That's a passive income. So the passive loss here on the real estate can go against the passive income or gain you had from the mutual funds. Does that make sense? So passive losses, null passive gains. Active losses, null active gains. And that's where it gets tricky. Next page. In some cases, tax laws on deductibility of losses from rental property are complicated. In some cases, they are classified as passive losses with limited value against other income. The investor's particular situation should be discussed with who? Where it says CPA, I want you to change that. You can cross it out and you're going to write best friend. I'm serious. Cross it out and write best friend. Because as an investor, which you are as of now, you're investing in classes, so at least that makes you an investor to start. As an investor, your CPA should be your best friend. Over the next couple of years, you should consult regularly with your best friend. You guys got it? Unless you want to pay a lot of taxes. That's totally up to you. Look what it says next. An investor, I already explained this, so right now I just want you to highlight and put stars. An investor may not use a loss from a passive activity, one in which the taxpayer is not an active participant, to shelter active income, such as wages, or portfolio income, such as stocks, dividends, bank interest, and capital gains. So it gets complicated. And that brings us to tax credits. There's a difference between deductions and credits. See, a tax credit is a direct reduction in tax due rather than a deduction from income before tax is computed. A tax credit is therefore a far greater value. See, investors in older building renovations and low-income housing projects may use tax credits to offset tax on up to $25,000 of other income. So that means, please highlight, underline, put stars, that means that even passive investors can take advantage of tax credits. So even passive investors can take advantage of tax credits. Next paragraph. Tax credits have been provided by taxpayers who renovate historic property. So if it's a landmark or historic property, the allowable credit, right here at the bottom, is 20% of money spent on renovation. So you spent $100,000 on renovation of this historic property, automatically you get a credit of $20,000 on your taxes. Automatically. Perfect, right? And that's whether you have active income or passive income. Doesn't matter. Here, it's automatic. If it's non-historic and was placed in service before 1936, it's 10% instead of the 20. And then my favorite is right at the bottom. You can get 4 to 9%. And before reading anything else, you guys are like, wait a minute, historic property is 20, non-historic is 10, and Bruno's favorite is 4 to 9. Read what it says next. 4 to 9 each year over a 10-year period. What does that mean in total? It means 40% to 90% of your money back in credits over the years. So which one is better? 20%, 10%, or 4 to 9 over 10 years? 4 to 9 over 10 years. But it only applies for expenditures on new construction or renovation of low-income housing. Over at Curvington. Right? That's why you need to know your market and the benefits of your market. If you get a good CPA, you get all these benefits. You don't have a CPA, they don't check off on the benefits.
So do you have your list ready of questions that people should ask their CPA to make sure the CPA knows what they're doing? Because a lot of people like to say, yes, I do a lot of.
Yeah, what kind of CPA are you? That's the question. What kind of CPA are you? Just like there's attorneys, they handle family cases, right? There's attorneys that handle corporate cases. There's attorneys that handle traffic cases. And then there's attorneys that handle what?
Everything.
Real estate. No, real estate. Those are the ones you want, right? In this case, you want a CPA that's mainly focused on real estate investors.
Okay.
Simple.
See, but you can't tell us, a lot of people don't even realize that there's different CPAs.
I know, and that's why I'm telling you now. Jeez. I did tell you in the beginning of this chapter, if you guys don't have one, let me know. I can recommend a few. But yeah, definitely get one that handles real estate. Very important. If that's your main business. If that's not your main business, then it really doesn't matter as much. Installment sales. In front of it, I just want you guys to write land contract. Installment sales or land contract. Okay. You guys remember land contracts? They're similar to car financing. So that means that you're paying the seller over a period of time with interest. And because they're not getting paid all at once, there's no capital gains. Because the capital gains is only at the time of sale, right? So that means that any profit, right on top, is reported year by year as it is collected. And that means that income tax calculations are figured at the investor's marginal tax rate. What is the marginal tax rate? Whatever tax bracket you're at. So if you're at 23%, every year you pay 23% of that income. If you're at 30%, every year you pay 30% of that income. Versus capital gains, which are I sold the property and I pay 15%. Right? So, and again, these are maximums, these are not exact numbers. With a CPA, you'll be able to reduce some of these burdens because they know exactly where to check off or not. Real estate investment syndicates. We already addressed this in chapter 7, so all I want you guys to do right now is this. Look at the screen, don't highlight. Do not waste your highlighter. You see all this? Okay, so circle, first paragraph, circle only. Right? Just go around it. Highlight around it. And then where it's in green, we're just mentioning again that joint ventures last for a limited time and is not intended to establish a permanent relationship. Right? Next paragraph, what do? Box around it. That's it. Circle or box around. Second paragraph. Third paragraph, what do? Guess what? Same thing. In chapter 7, I already talked about this. Here's just reiterating everything we said. And the next paragraph, you're just going to highlight the first sentence there. It says, syndicate participation can take many different legal forms, from tenancy in common to joint tenancy to various kinds of partnerships, corporations, and trusts, which again, we already know from chapter 7. All the way at the bottom, I want you to highlight real estate securities must be registered with state officials and or with the Federal Securities and Exchange Commission, or SEC, when they meet the defined conditions of a public offering. Now, salespeople of such real estate securities may be required to obtain special licenses and registration. Okay, so you might have to register with the SEC as well. And get special licenses to get involved in this. Forms of syndicates. We talked about general partnerships, limited partnerships, all that, right? What I want you to highlight is right above real estate investment trust, The same thing we highlighted in chapter 7. If it's a limited partnership, all you stand to lose is what you invested, nothing more. General partners are always totally personally responsible for the excess losses incurred by the investment. So in partnerships, it says personally responsible. What does that mean? That it goes beyond the business, personally. So I might have to sell my house to satisfy whatever the lawsuit is. That's the problem with partnerships. So always look for LLCs, way better because it limits everybody. The next we have is real estate investment trust. Real estate investment trust. We talked about this in chapter 7 briefly. I told you I was going to mention something in detail in this chapter, which is a REIT must have at least 100 investors to be considered a REIT. And at least 75% of the trust income must come from real estate. So if the question says 83 people get together and 100% of their income comes from real estate, this is a good example of, gives you 4 options, or it says it could be all of these except, gives you 4 options. One of them is REIT. Because it doesn't have 100 investors, even though it meets the income requirement, it doesn't have at least 100 investors. Is this a REIT? No. So that's the only thing you need to look at. If it doesn't have at least 100 investors, it's never, ever, ever a real estate investment trust. You got it? Great. We're in the final run. Business opportunity sales. All right, guys, quick question. Your license is going to be a New Jersey real estate salesperson or broker license. But it says real estate. Does it say business? Does your license say business?
No.
So can we get involved in the sale or rental of businesses? Why? My license doesn't say business. Can I? No. It's not because it's part of real estate. It's as long as it has real estate. Because not all businesses have real estate. If it's an online business, do we have real estate?
No.
No. So the reason why we can participate in most business opportunity sales is because there's either a title or lease to be transferred. So by association, what can we do? Participate in that sale. You guys got it? I know this is a tough chapter.
So many bullets.
I know. It's not easy.
That's why you did the quiz before, right?
Hmm?
That's why you did the quiz before, right?
Oh, if I've done this chapter and then the quiz will be out the door in 5 seconds. Can you please help me? All right. Right here it says that you have to be also a real estate licensed broker if you want to get involved in these transactions. As salespeople for the broker, can we get involved?
Yes.
Yes. All right. Besides title to real estate or present lease, the business might also be selling what? Fixtures and stock and inventory, business name, customer lists, goodwill, and special rights, or such as copyrights, patents, franchise, so on. Very, very important you guys ask these questions. When somebody's selling their business, is the name included? They might sell the business, but not the name. And sometimes the name is what gives it the business value, because it's established over the years. Does that make sense?
Yes.
What about customer lists?
Absolutely.
Of course, because if you're not buying the customers, right, not that you guys are for sale, but if you're not buying the customer list, then what kind of business do I have? A what?
A broke business.
A broke business. Because you need the repeat business. You guys understand? Any questions here? Simple, right? This part is simple. Now, these items just listed are personal property, and because they're personal property, they're transferred by bill of sale. Very good. Just highlight. I'm sure you guys understand this part. Now, the broker should gather as complete information as possible about the business. That's common sense, isn't it? If somebody's selling their business, they need to show their value. So accountant statements, which we call P&Ls, right, profit and loss, and income tax returns are essential. But I've heard people that are trying to sell their business are like, hey, when I bought the business, I didn't look at any of that. So why did they need to look into my business?
Because you're putting it in there now.
I didn't say it, you said. Right? But I have a couple, they're friends of mine, they bought a business in Elizabeth, and that's what they did. They bought the business blindly. Because it was so profitable at the time, they just jumped right into it. And then, unfortunately, the economy went down, and while they were trying to sell, it was just getting worse and worse, and they did not want to release their books. Why? In this case, because there was none. Right? They didn't keep any records, so it was tough. And they were dropping price until it got to a point where it's just kind of like, hey, take it, whatever. Not even inventory money. Speaking of inventory, we should talk about this. Are fixtures and equipment owned? What is their fair market value? Are they leased? Can the lease be assigned? So there's a lot of questions when you go sell a business. It's not just, oh great, how much money you make? Are you selling the name? No. Everything that's here. Do you know if these chairs and these tables are paid off? It's chairs and tables, so probably, right? Never assume or presume. There could be a lease. It could be financed. It could be a lot of things. Do you know if these TVs are paid off? Do you know if the camera's paid off? Always ask questions. Okay?
Do your phone come with the deal?
Sorry?
Do your phone come with the deal?
Everything. Well, my phone? No, because it comes with me. The phone number.
No, in this case, like you use your phone for the video, so that's what I'm saying.
I use my phone for the videos.
Don't you?
No.
Oh, okay.
My phone has the cameras,
That's what I meant.
so I know who's out there. That's it.
Oh, I see what you're saying.
Yeah. All right, UCC, Uniform Commercial Code. New Jersey has adopted the Uniform Commercial Code, which regulates the transfer of personal property. Now, the section of this code that is most applicable to a real estate business is Article 6 and known as the Bulk Transfer Act. And I want you guys to pay attention to this because a lot of real estate transactions do not fall under this. And it could screw up a whole deal because of something they require. And I'm going to show you guys how to get rid of it real quick before the closing. Okay? In most businesses, supplies, goods, and services are constantly being purchased on credit and paid for as suppliers submit their bills. We know this, right? Most businesses, they try to get to the net 30, 60, or 90. Like, I'll pay you back in 3 months. Okay? The Bulk Transfer Act is designed to protect creditors from the fraud perpetrated by a business owner who sells the business, including equipment and stock, and then disappears, leaving creditors unpaid. Has anybody heard of these stories? I sell my business, I'm out, and then all of a sudden somebody knocks on your door and says, this bill is not paid. Right? We hear a lot with restaurant businesses, bakeries, pizzerias, most common. In such a case, the creditors cannot demand payment from the new owner unless it can be proved that the new owner had actual knowledge of the fraud. To prevent such fraud, Article 6 requires that the following steps be taken when the business is sold. For now, I just want you to highlight the bullet points, because right after the bullet points, I explain the exact same thing. I don't know why they put so much here, but it says right here, the seller is obligated to prepare the list of creditors and is responsible for its completeness and truthfulness. That means if I'm selling the business, I'm the one that has to provide you with all this info. Common sense, isn't it? Look what it says next. It is against the law to make false statements on such a list. The thing is, a lot of people don't even know this list must be made. A lot of realtors don't even know this. They learn about it in class, and all of a sudden they're pros, and they're helping somebody sell a business, and they forget to get these lists completed.
The lawyers.
The lawyers?
Mm-hmm.
Like they know.
Exactly.
It's a don't ask, don't tell. If you don't bother me, I won't bother you. All right, so after receiving this list, the purchaser is obligated to notify the listed creditors. So what we're saying is, I'm the seller, you're the buyer, I gave you the list. It's your responsibility now to contact every single creditor and say, hey, I'm about to buy this business, right? I'm just verifying everything that's on this list, right? And that must be done at least 10 days before the sale takes place, okay? New Jersey statute of limitations on bulk transfers is 6 months, so unless the transfer has been concealed, creditors have 6 months to file any claim on title to personal property after this notice to creditors has been sent. So I contacted every creditor. In 10 days, I'm going to become the owner of this business. Is this list true? They'll verify their stuff. After I gave you notice, you have 6 months to try to come back and resolve it. Beyond the 6 months, what I have on the list is true and stands. You guys got it? Great. Because if the notice to creditors is not sent and the business is sold without first paying existing creditors, a creditor may enforce a lien on the goods and equipment as if it was still belonging to the original owner. And that's the problem. When people disappear, if the buyer knew about it, right, he's liable for it. If the buyer did everything possible to take care of it, then they're not liable for these expenses, or might not be liable for these expenses. And that's why it says right here, the requirements of the Bulk Transfer Act are designed to protect the interests of the buyer, as well as those of the seller's creditors in the sale of a business. And to finalize, look what it says right here. Non-compliance with the law is a criminal offense in New Jersey. This next sentence is where you guys need to pay attention. Here's what happens. When you sell a property that's under an LLC, it automatically triggers the Bulk Transfer Act. And they require something called bulk transfer tax. It's where you prepay or put in escrow where you're supposed to pay in taxes. And then at closing, they'll release that to the New Jersey taxation department, right? But it says right here, real estate is not covered under the Bulk Transfer Act. Please underline, double underline, triple underline, just business, personal property.